This week, we're going to dig into how one's perceptions of the market might affect their long-term investment strategy. So a couple weeks ago, I was on a call with Dr. David Kelly. He works with JP Morgan as the chief global strategist. Basically, it's his job to give some viewpoints on global economic events that are happening to advisors in the financial world. But he had a quote on there that is going to be in the written commentary that you're welcome to take a little more time to read yourself if you'd like. But I want to dissect it a little bit more because I think there's things in there that as individuals with our own biases and thoughts on how the markets might work, that could affect the actions that we might take, right? Our own perception of a quote that might lead to inaccurate actions. So with that, we're gonna dig into cash holdings, market performance, how the market is made up. And when I say the market, I'm referring to the S&P in this particular case and how it's a market-weighted index, and then how that might lead to one's perceptions of the market being overpriced or underpriced. But first, let's dig into his quote a little bit to give a little more context. Dr. David Kelly starts off with a few ideas that JP Morgan has as to when the Fed is going to cut rates in the second half of 2024. And again, those are shared in the quote. But a few things that I want to address in this particular quote is his line on, there are two problems I see with markets. One of them is that people like to huddle in cash because cash is giving them a good return. Right? So yields are up. We're at historically high yields we've not seen in years. And we have to remind people that when you're at peak CD yields rates, right? We've seen a flock to money markets. We've seen a flock to CDs. Almost always there's something better to do. It's that adage of buy low, sell high, right? People are flocking to cash because yields are attractive. Certainly can't be argued with. And then he goes on to say, we've seen this over and over again, where you get a rally off the stock market and a rally off the bond market. Long-term investors shouldn't be sitting in cash. Long-term investors should be in a diversified portfolio of varying investment classes. And when I say market cap, all that means is the number of outstanding shares that the company has times its share price equals your market cap. And so when one's share price increases, so does its market cap, and so does its percentage of the S&P that it makes up. We've heard the term the Magnificent Seven. They are some of the highest market caps in the S&P 500, and they were also centered in tech. So when someone says the market is at all-time highs, what I want them to understand is that there is more to the market, the S&P 500, than just those Magnificent Seven stocks, right? A lot of the S&P had struggled over the prior few years. That doesn't mean that all of the holdings in the S&P 500 were positive. It could mean that the top performers just happened to be the highest market cap weighted indices. So all that to say, really, during periods of time when folks say the market is, at all-time highs, I don't want to get into the market, I think what's important for people to understand is that there is not one market. It's not just the US centric S&P 500, right? When we are investing for folks, we're running a globally diversified portfolios, but even when we're not talking geography and we're talking just US equities, there are a lot of different types of companies that do not fall into the S&P 500. When a large cap blend like the S&P 500 is doing really well, that might mean that small cap equities are not. When I say small cap versus large cap, all that is going to be its market cap in certain bands, right? So smaller companies are going to fall into a small cap, large companies are going to fall into a large cap. There is defined bands that are shown on the screen to give you an idea of what constitutes a small cap versus a large cap versus a mid cap even. But that doesn't mean that any one market is doing better or that the other is not performing at all. So there's always an opportunity to invest in the market. You just need to know where to look. So all that to be said, again, don't always just sit in cash. Just because yields are all-time highs, that means there's a lot of opportunities out there. We've talked before, and we can reference back to the commentary that Tim and Dave did a few months ago, explaining how fixed income works, right? How bonds work. There's an incredible opportunity in bonds if we see the Fed start to go and cut rates, right? Just as a reminder, bond values go counter to interest rates. So when interest rates are going down, bond values go up and vice versa, which is why we saw a couple of years of really poor performance in the fixed income markets because of the Fed going and raising rates over time. So while cash can be a solid investment for a shorter term investor that might have that earmarked for a 6-month, 12-month maybe even a 2-year time frame with where interest rates are right now, it's not a solid long-term investment strategy for someone looking to retire in 10, 20, 30 years. We need market appreciation. We need globally diversified equities and diversified fixed income and diversified real estate, right? Which is why we tout diversified portfolios. So while the market might be at all-time highs, and again, the market is the S&P in this particular case, that does not mean that there are not opportunities within the true broader markets and other sub-markets to be able to invest, take advantage of down periods, and generate a little bit of alpha in your portfolio. If you have any questions, feel free to reach out to us here at 10 Capital. We're always happy to chat. Until next time, have a great weekend.